I think this initial surge in gold that we're getting with this breakout that we could see this week, if we close over 2118, can easily take gold up to 2600 area. There's some
Wow.
technical reasons for that. Okay, now that's not a big deal. Percent wise,
Right.
okay. I bet miners and silver outpace that triple fold
Wow.
in terms of percentage. So you want to be in the little dogs, the places you didn't want to be the last 3 years. You want to be in them now.
Michael Oliver, how you doing?
I'm doing great, Andy. How are you?
Doing really good. Great to have you on. Last time we talked about, I just want to get right to it. The last time we talked about crazy things were about to happen in the economy. This was the last December. We thought we saw a topping pattern in the stock market, if you would.
Mm-hmm.
And we talked about how watch the bond market, the yields on the bond market, and they would be a great indicator for the overall economy. Let's talk about that. Jump into it.
MSA looks at things from a technical point of view, and I don't mean price charts. Okay. Yeah, we look at the price charts, but we look at momentum of price. So what we do is we oscillate price versus certain means, long-term means, shorter-term means, and we get a different visual picture of what a given market might be doing than what price might be trying to tell you. And quite often, price is lying. Okay, we know that historically. It looks great and it's the top. Looks terrible, that's the bottom, etc. Anyway, our assessment is this, that over the last year plus, T-bond prices have been in sync with gold action, especially evident on intermediate trends like several months at a time. As an example, last December was the Fed minutes, and they said, oh, next year we're going to cut rates sometime next year. But it was sort of nebulous. Everybody was hoping, well, by summer, and then they moved it up to March, not the Fed, but the analysts and so forth. But at that time, the S&P started to accelerate on the upside and the NASDAQ 100. So if you look at their charts, go back to December and you see, boom, up, sharp up move. Probably in an eager anticipation of the Fed is going to give us free money again. And also NVIDIA and stuff like that took off, the limited leadership. But at that point in time, if you look at T-bonds, prices started to come down, not drastically, but come down off of the highs that they'd made from that October V-bottom low. We had forecasted a nuke event last year on the downside for T-bonds, meaning a sharp drop in price, but to be followed by a V-bottom, which we didn't think it would sustain. It was sort of a panic sell-off in the T-bonds. Ended in October. Well, when did gold make its low last year? October. Okay. They both surged into what? Late last year, basically, December.
Yep.
And at that point, gold started to pull back from its brief surge above 2100, and it wasted a bunch of months pulling back. T-bonds have done what since their surge off the October low? They went up and made peaks in December. TLT, for example, the T-bond ETF, was down at 83. And within about 8 weeks, it was back to 100. It's a big percent move for T-bonds, big drop in yields.
Okay. Huge.
And the gold was going up same time. But at that point going forward, both those markets pull back in synchronization, almost week by week overlays, while the stock market continued to soar. So we think they're in opposite trend situations right now, where we think T-bonds and gold will likely, for the foreseeable months ahead, not necessarily for years, but for the next couple quarters anyway, likely be in tight synchronization, meaning as the yields drop, T-bond rally occurs, gold will also be surging. Gold's acting quite good right now, as we all know. T-bonds are trying to reassert themselves after the recent pullback low, and stock market's suddenly starting to wobble a bit. We've got some key numbers on the stock market, by the way, that suggest that, in fact, it's around today's lows in both NASDAQ and S&P. You close much around today's lows on any daily basis this month. And we think those two indices are going to start to drop. Not crash, but start to drop and disappoint folks. Like, what's going on here? How come we're back below the 2022 price highs? And that kind of questions. But at the same time, we expect bonds and gold to not turn up, but to advance, to continue their advance that began from last October's low, opposite to the stock market. So I sent you some charts on T-bonds that show the action of the last several years in price going down, yields went up, and the action, especially the last year or two, where when you look at price, you see this arduous downtrend. When you look at the quarterly momentum, let me explain what that is. We measure each monthly bar of T-bond futures, high, low, and close, plotted in relationship to where the current 3-quarter moving average is that quarter. And that changes every quarter. Every new quarter, you recompute to what the new 3-quarter moving average is. And that's like a 200-day average almost in terms of duration. Well, right now, T-bonds are trading the front month contract, which is June, and even the March is trading in line with where the June is. The June futures are trading above 120 on T-bonds. They close out any month, during this quarter, if they close out a month well above 125, they're going to break out on this quarterly momentum chart. But let's assume that doesn't happen. Let's assume all we see is continued firming here. Next quarter, meaning in 4 weeks, get into April, the structure that they're going to break out on when you look at that quarterly oscillator, which is a flat structure that goes back through highs in 2021, again, early last year. It's like a flat ceiling. You cannot see it on price, but on momentum, it says you go through this and you're going to take off. And that number for next quarter, meaning next month, is 122 area. There's 2 points above where current T-bonds are trading. So another couple point rally in T-bonds, and they're going to engage this longer term trend structure to the upside, meaning what you've seen on T-bonds for the last few years, which is this staircase decline on the top chart. You see this flat structural momentum. And when that momentum breaks out, that price chart pattern is going to shift upside, meaning we're going to get lower yields. Right now, what have the stock guys been saying? Oh, that's all we want. We want the Fed to pause, cut rates, be party on forever. Okay. They don't do their history very well. You go back to 2000, Tom. Rates have been rising from 1999 to 2000, mid-2000, Fed quit raising rates. Stock market peaked in August of 2000. S&P 500 did its highest monthly close. And in fact, the month before that, in July 2000, the Fed suggested they're going to go flat for a while. Okay, so it was good news. So the stock market had it rally into August. That was the top. In January of 2001, several months off the high and not too far off the high in price, the Fed started drastically cutting rates. What did the stock market do? Collapsed for 2 years while the Fed cut rates for 2 years. Let's go to the 2007 top. Summer of 2007, S&P was laboring below its highs that it had seen all during 2007. September 2007, mid-month, 1 month before the price high in the S&P, the Fed cut rates by 0.5%. S&P, oh boy, party on. They went and made a new high in October. In fact, they hit a target zone that we'd predicted would probably be the topping zone. But they partied after the Fed rate cut. Fed continued to cut rates for the next few years, stock market collapsed. But what did T-bonds do during that time? So if you were looking at T-bonds as an aid to having a bullish view on stocks, you would say, well, if yields drop, that should be good for stocks, right? Okay. Well, there's a T-bond chart on the next page I sent you that shows what was happening back then at that 2006-07 period. T-bonds had been under price pressure, yields under pressure, to the upside, that is, and stock market beating its chest on the upside. And when stock market broke out above its price highs of September and got up in October high in 2007 on the S&P, T-bonds broke up out of their base, momentum base, which was a downtrending line instead of a flat line like we have now. Look at the quarterly oscillator below that price chart. You'll see a very clear trend line that an idiot could draw, if only you were using momentum instead of price. It broke out in October of 2007. That momentum chart said, I'm going up, meaning bond yields are going to start dropping dramatically. S&P topped then. And if back in 2007, you said, boy, if only the Fed would cut rates, that'd be good. Well, they did, and it was the top in the stock market. I think we face the same thing right now.
So, yeah, a lot of info there, right there. I'm assuming then, again, looking into the layers of this, that this is a flight to safety. Then if we're just looking at bond yields, people are starting to sniff out, this is a flight to safety. I need to park my money somewhere. Yes.
Mm. Yes. Well, see, last year, 2022, should be 2 years ago, we had a big bad down year in the S&P, NASDAQ especially, and a big bad down year in bonds, meaning yields were rising.
Right.
So they were in sync at that point in time. So a lot of like, oh, they're in sync with each other. So if yields rise, that's bad for the stock market. But if yields drop, that's good for the stock market.
That's my normal thinking.
Yeah,
Yes.
that's the normal thinking. But at both the 2000 top and the 2007 top, that was absolutely wrong. It was totally reversed the other way. We think bonds are now poised to shoot up out of here, and I think you're dead right on that. The old 60-40 portfolio mix, 60% stocks, 40% bonds, you're balanced, right? Well,
Right.
you got hung both ways in 2022. The bonds were down 35% price, like NASDAQ 100, S&P down 22% price. You got killed.
Right.
60-40 portfolio on both sides of the equation. They were not a good place to be, T-bonds. This time around, it's going to be opposite. This time around, the technicals totally are reversed, and it looks poised where I think some major asset managers are already sniffing this out. And there's a lot of them out there, you hear from them occasionally who they're skeptical about the stock market, but they have to play the game because if they don't, they get beat by their peers in terms of performance of the portfolio. So they got to be there even if they don't like it. But if you give them the least technical excuse or maybe some fundamental data point, and they're going to start moving that money from the 60% into some of the safer categories. Well, what's a safe category? Look back at the last couple of years. Gold. That's possibly why, Druckenmiller's moved into the two top gold miners. And I've heard some other major asset managers have done the same thing. That's Newmont and Barrick.
Mm-hmm.
And I think T-bonds will also be viewed, this time correctly, as a safe place to be, at least for some time.
Yeah. It makes a lot of sense. And Stanley Druckenmiller is one of my mentors, if you would, from afar. So it's interesting. Let's talk about gold then and what this means then for gold. We have a flight to safety in T-bonds. Typically, if we're also looking at if T-bonds rally as we assume that they will, it also means like a flight to safety. Yeah, just talk to me about gold. What is this all about gold?
Yeah, they're in sync. And in fact, gold has been tending to actually lead T-bonds over the last year by a week or two. For example, go back and look at that low in October in gold. We pegged the turn up in the first week in October. It was like 1860 gold at $40 off its low. We said, okay, that was the bottom. You turn it up. Well, TLT at that point, the T-bond ETF and bonds, continued down for another couple of weeks. So they weren't quite in sync week by week, but certainly by the end of the month of October, while gold had already exploded a lot, the T-bonds also exploded. So there was a bit of a lag there. Well, right now, what do we see? We see gold has come up out of a recent hold where they keep pushing it down to 2,000 over the last, since the December high. They've taken it down under 2,000 twice. Very briefly, 1990, 1980, that kind of nonsense. Stayed there for like 4 hours and it's right back up. Finally, you turned up decisively a week or so ago in terms of gold's momentum action and even price. Now it's evident on price. Whereas T-bonds are still back below the recent high they saw late last year, early this year, but they're heading back that way. So they're a bit lagged to gold, but they are in sync. So gold isn't waiting on T-bonds, I don't think. If anything, gold is leading what's likely to happen to T-bonds. Gold is, it's an old market, been around 3,000 years, right? It's pretty smart. Yeah. So maybe it doesn't need data points. Maybe it anticipates that stuff,
Yeah. It's interesting too, and this is just feel and tape reading, which can really get you hammered. But the gold market right now in this move just seems really strong. That it has momentum, if you would, or just a lot of wind at its back, if you would, right now.
Well, there's a chart essentially that shows that. It's a lag chart, meaning we've got a lot of other buy signals before this occurs, but it's a 100-week momentum of gold, the oscillator that's at the bottom of that page. And what does that mean? Well, I'm averaging the weekly bars of gold in their relationship to a 100-week average. It's like a 2-year average. It's a very long-term average. You can see there's a ceiling on that oscillator. You've bumped it like 4 times. You close out this week at 2118 or higher. April future, right now 2140 or so. We closed out this week 2118. I'm going to take out all the closes that define that ceiling. So it's saying I'm engaged.
Yeah.
It's a powerful breakout structure, and it's likely to change the tenor and the tone of that market, from arm wrestling to more upside jolt.
Got it. What kind of upside are you expecting or looking at then?
Well, what we're really looking at, and we're pounding the table over, is the miners, which have behaved like, I won't use the expletive, over the last couple of years relative to gold. They had a huge performance surge into 2020. They beat the pants off of gold.
Right.
In fact, some of them, like Newmont, continued to beat gold and the gold miners up through a year and a half ago. It's continued to soar relative to those, and also in price. And then all of a sudden, the miners have after this 3.5-year arm wrestling match, they had a puke, like
Yeah.
LT did.
Like 3 weeks ago.
Yeah,
2 weeks
and it
ago.
was just to us. It looks just like that T-bottom low we made last October, where it looks like just giving up. It's no good, going to hell, right? Expect to be bottom out of here. And I think as gold is breaking out over that major momentum structure that we show on that chart, the gold miners have a similar structure on the oscillator I sent you. That's a 200-week momentum chart, meaning we're measuring each week. Where is it in relation, percent above or percent below the 200-week average? Not 200-day, 200-week. That's like a 4-year average. That momentum chart has a structure that you can draw with a crayon. It goes back to 2020 highs. It's a 4-point downtrend line. You cannot see it on the price chart. So if you're looking at the price chart for a reason to buy, breakout, you got to get way up there, upper 30s or something. But on this momentum chart, you're like about a point below the breakout level right now, today.
So we're right there.
Well, you get above 31. You get actually 30.40 this week is a breakout for it. Well, we trading up to 29.15 today. Now that number is going to drop just a little bit each week. At 30.40 this week, close on GDX. A 30.30 something close next week will break it out. You break out that multi-year structure and bet that miners will come out of this recent nuke event for them, where they're vastly underpriced to reality, underpriced to gold, underpriced to the stock market like never before. Expect the upturn not to be an arm wrestling one, but more vacuum-like. So what we're seeing on gold is important, but I think it's even more important for the miners. And I can't stress it more. I think the miners are probably the most undervalued asset category I've ever seen, and technically ripe to exploit that. And we shall see probably in the next few weeks.
Wow, interesting. Okay, so let's talk about that. Is in the next few weeks, anything that we should be aware of then, or just watching those momentum indicators that you have?
I think what you got to watch, if you're watching gold, you want to watch the stock market, because we are adverse to that market. I know a lot of people think, oh my God, stock market goes down, gold's going down. Baloney. Go back to 2000 top in the S&P. Gold was making a bottom. Stock market went down for 2 years. Gold went up for 2 years. Major percentage move. Okay. 2007 in September, October, when stock market was peaking, you could have bought gold at 600. It was up to 1,000, within a year or so. T-bonds went up big too. So I think we're in a situation now where we're probably nearing the last year or so of the gold bull market. But if you go back and look at the prior bull markets in gold over the last 50 years, it's that last year or so where gold goes ballistic. Look at 1979. It had already been going up since the mid-1970s when it was at the $30 range. 1979, it was, it had a nice, arduous bull market, but it exploded percent-wise in that final year. Silver went up ballistic in that last year. It vastly outpaced gold. So did miners. I think we're in the same position right now, such that like in the 2000 to 2011 bull market, much of that advance, especially in silver, occurred late in the bull trend. We bottomed in 2015, late 2000, last month of the year. Okay, so let's count 16 onward. So, we're like 8 years into this beast. We think that the tail end of this bull could take gold off the page. And I put out numbers before that people laugh at because we're not there yesterday, okay? People are impatient. I think this initial surge in gold that we're getting with this breakout that we could see this week, if we close over 2118, can easily take gold up to 2600 area. There's some technical reasons for that. Okay, now that's not a big deal. Percent wise,
Right.
Okay. I bet miners and silver outpace that triple fold
Wow.
in terms of percentage. So you want to be in the little dogs, the places you didn't want to be the last 3 years, you want to be in them now.
Got it.
Gold engages like that. Bet silver's going to be, it's now what, $24. You'll probably be well beyond the 30 level and on your way toward the 50. Miners will likely go back to their highs. We're 28, 20, 29 on GDX. Its high was what, 45 something in 2020?
Right.
That's a percent move just to get back there. So I think you could have drama there. But the S&P, the stock market, I think is a key technical variable here, because as it breaks, and we've got some monthly momentum structures, I don't want to bore everybody with all this stuff, that we're toying right now with breaking a 4-month wide floor on the S&P that you cannot see on a price chart, but you can see on monthly momentum. And same with NASDAQ. You break that floor, no, you're not going to crash, but you're going to come significantly off the recent high. And our bet is that all these silly data points that people like to look at as justification for the Fed doing this and cutting rates, you're going to start to see those data points. But the stock market usually will lead that process. And so it's like a month or two off the high, and then suddenly you say, oh, there's the data points. The problem then is it won't be beneficial for the stock market, even though it might cause the Fed to cut. Stock market will be entering a bear trend. And so everything that people have been cheering about, when it finally comes, you don't want to see it.
Right. Right. Interesting. Okay. So the next week, next several days, next week is going to be very, very telling. So
this happened to be a timely interview, I suggest. Yeah.
We're getting it out tonight. So really, that's all I got, Michael.
Okay. Well, I think you got a lot. And those charts, if your viewers can pause the screen and look at those charts a while, I think they'll see some interesting data points there. So anyway, Andy.
Absolutely. Well, thank you very much. I'll put in your contact or your website and Twitter in the show notes, and just really appreciate your time.
Thank you, Andy, very much.
Thank you. Have a good night.